So, welcome. This video will be for people that want to be a trader and they're just about to start. So, you want to be a trader. What does it exactly entail? What does it take? And can you do it? So, as we all know, trading is one of those careers, it's not linear, and progression is by consistently improving yourself. And it's not like a set career like a doctor or engineer. So, what does it actually take to become a trader? Okay, so the first step is obviously gathering information. Now, what information? Well, the information that you need is basically a set way to a school of thought for you to trade in a specific way. That's the sort of information that you're going to need, and risk management styles, types of assets, different trading styles is what you're going to need to know. You're not going to action on all of them, but it's just useful information to have. And last thing is, over time, you realize not all knowledge is good knowledge because you're trying to learn one thing and master it rather than just adding on random stuff without building upon a base first. Now, first thing, what information? Well, in terms of information, you want to be able to basically look for correct information that could help you for a trade. Now, what that means is you don't want to look for signals because that doesn't teach you anything. You want to look for specific school of thoughts that will help you in your trading journey. Okay? Now, the choice between market assets, stocks, and bonds, I'll be going through. Next slide. So, the first one is obviously the ones that I've come across, FX pairs. Now, the benefits of FX pairs is that there's loads to choose from and it's pretty much open a lot of the time. And as the market is so large, right, there's a lot of good execution. So, as soon as you enter, you're relatively safe in terms of your entry price. And they're less prone to worldly events because it takes a lot more for them to be affected. Now, with FX pairs, they can also be affected by the market, especially high impact news. So you may see price just consolidating till news comes out. Seasonality is a big thing in FX pairs because if they're less prone to worldly events, that means whatever cyclical patterns happen, they're more likely to happen in FX pairs compared to any other market class. There's less impact on them. Now, the best pairs, in my opinion, would be Euro USD, pound against the USD dollar, AUD USD, NZD USD, New Zealand dollar, Australian dollar, US dollar against the Canadian dollar, US dollar against the Swiss franc, US dollar against yen, pound against yen. Now, the next asset class is indices. Now, this is a faster moving market compared to FX pairs, and the news can be used to accelerate whatever's going on in the market. It's more prone to events than FX pairs, but less prone than stocks. And it's ideal for people that already have experience in the markets and they know the sort of style they want to trade because it moves quite quickly, it moves a lot. And it's also ideal for day traders just because of that sole reason. You just mark it out and you see what's going on every from market session open and you see how it moves. Now the downside is you don't have as much time compared to FX pairs as the markets close earlier than FX pairs, and news can be very, very, very volatile. You can literally be in and out very quickly. Your stop losses can be hit very hard. That's the downside of indices. Next one is stocks. So stocks is open 9 to 5, and in New York, and this is ideal for longer term investments. Whilst looking at fundamental data. The reason being is because with the fundamental data, you get to see where it's most likely going to go. You only use technical analysis for an entry in that direction that you think is going to go. And therefore, it will also help with your entries and your profits. And if a specific news coming out relating to that stock, it's very, very likely that it will be affected and huge movements will occur. Now, this is ideal for longer term traders as you just place your position based upon fundamental and technical analysis and you just hold it basically until it gets to your desired level. Now, the next thing is trading style. everyone has a different personality and everyone has different trading styles that they want to go by, right? You need to understand how patient you are. If you're not patient, you can't really hold trades long, then position trading may not be for you. If you are impatient, then scalping may be better for you. Do you like risk? Now, risk, the scalpers, day traders, and scalpers and day traders have more risk compared to position traders and swing traders because they need to continuously make informed decisions that provide obviously useful information for them. Provide some benefit. Now, the last point is, do you like keeping up with news? The reason why is because if you look at fundamental data and you enjoy that thing, it may be beneficial for you to do position trading because you get to see the actual changes in the underlying data before the market moves. On to the next thing, trading information. So this goes hand in hand with the previous slide, trading style, because once you get some information, you sort of, depending on your lifestyle, depending on your work, will be able to get an idea of the sort of style that you want. Now, there's different schools and trains of thoughts. The best thing to do is you don't jump the bandwagon. You just perfect the craft of one. It's like if I decided to learn French, then I went to English, then I went to German, then I went to Spanish, and then at the end of it, I question why I can't write a paragraph in either language. This is why you need to stick to one, be very, very good at it, know the ins and outs, know the pros and cons. That's when you'll be able to develop a system. Now, each of these different types of schools of or trains of thoughts that I've looked at, they all have their pros and cons. Literally all of them, and they all do work. That's provided if you know how they operate, when they're meant to work, and how you can apply that with your trading style. So, for example, let's say look at support and resistance, right? With support and resistance, that will work. You need to know when it will work, when it won't work, and you need to know what time frame do you want to use if you want to be a swing trader. What time frame do you want to use if you want to be a day trader, right? Then you have ICT, which is another school of thought where you look at how price is delivered algorithmically, and you focus on balancing the range. You got trend trading, breakout trading, range trading, reversal trading. I'm not going to go into too much information on that unless you want me to. You can find these on YouTube. So, let's say at the end of it, you've come to a conclusion that you want to do a specific school of thought or train of thought, right? So let's say simplistic trading. For simplicity, you decided to do trend trading, okay? So that means you're going to need to know all the ins and outs for trend trading, okay? The next thing that comes in is risk management. Now, this is the most important piece of the puzzle of your system that you build. The reason being is because if this is profitable, you can still mess it up if your risk management is not good. All of these could be highly profitable, but if you have shit risk management, then you mess it up. This is just simple as. Now, risk management boils down to a few things, right? First is how much are you willing to risk per trade? Okay. This is very important because it will basically determine how much you're willing to lose per trade and how much in drawdown you're going to be and your equity curve. Okay. The next thing is R2R, which is basically risk to reward ratio, and simply what that means is if I put in £1 or £10 or £100 or whatever, how much am I willing to get out, or how much am I looking to get out of the trade at the end basically. If I put in £10 and I get £30, that's a risk to reward ratio of 3-1, right? Then the final thing is overall strike rate, which essentially means how many times, as soon as you place your trade, how profitable is it? Okay. Now these three things go hand in hand, right? Because the way it works is these three will determine your profit. Okay. If you risk more per trade, that means you can make more profit. obviously. If your risk to reward ratio goes up, that means your profit is going to increase as well. Rather than getting 3-1, you get 4-1, 5-1, etc., etc. And obviously, if your strike rate goes up, meaning how many times you're right, then your overall and everything goes up. Now, there is a relationship between these three, I would say. So, the more you risk per trade, right, you can risk more per trade if your strike rate is higher. Okay. Now, the way these two would link, right, is if your strike rate is higher, most of the time, your risk to reward will get lower. Okay. Now, if your risk to reward is usually higher, it means your strike rate will end up being lower. It's the balance between the two that will determine your profit and the targets that you should aim for, alongside the risk per trade. Okay. Now, once you've been able to determine your risk management process, so on average, how much R2R are you looking to trade? On average, what is your strike rate? Okay. Now, for example, if your strike rate is 50% and your R2R is 1-to-1, that means for every 50% you make £1, you lose £1. Okay. So that basically that whole strategy is break even. Now, if your strike rate is 50% and your R2R is 2-to-1, if it's 2-to-1, then that means for every pound you lose, you gain £1 as well. So essentially, out of 10 trades, if you take 10 trades, you gain £5. Okay. Now, the last part for risk management is once you've been able to understand these areas and you've made your system, how do you improve it? Okay. Well, there's several ways you can look to improve it. The first is, do I increase risk when a certain setup plays out, i.e. A+ setup where all my rules align? Do I increase risk when I'm going with the trend or against the trend? Do I move my stop loss to break even at a specific area? That way it is risk free. So for example, if it becomes 1-to-1, do I put my stop loss to break even and let it run? Do I do other things like take partials? So if let's say for example my strike rate is quite low, and my R2R is quite high, do I take partials? So then I take some profit and let the rest run. Right? These are the things you need to think about when you're doing risk management. As soon as you enter the trade, how do you manage the trade from entry to exit? That finally comes down to building a system. Okay, so like I said, you need to understand a whole school and thought process. If you keep switching between several of them, then you're not going to perfect any of them or understand any of them fully. Okay, all of them have pros and cons. All of them have benefits and drawbacks. Okay. Now, once you fully understood this, you want to look at risk management protocols. So, literally what I said, and you want to tie this with your own psychology. Now, the way you want to tie it with your own psychology, right, is, let's say, for example, your strike rate is quite low, okay, and you're one of those people that, but your R2R is quite high, and you're one of those people that really, really wants to have a higher strike rate because it messes with your psychology. Well, you could reduce your R2R and now overall increase your strike rate. Right. This is how you can play between the two, because you need to develop a system where you have rules from entry to exit and how you're going to manage that whole trade. And then finally, something that ties it all together is a systematic process. Now, the reason why that ties everything together is because the markets aren't going to be the same every day. So you're going to need to have a set process of how you enter the markets. Ideally, you want it to be a mechanical thought process with a discretionary system applied to it. That comes with time. I could go over it if you want. Just let me know. This is just a start. And the final thing is, once you've built your system, you've learned your system, you know your system inside and out. How do we improve it? Well, like I said, risk management process, and you also have adding extra confluences that you can add on, like a specific rule or criteria. Okay. Then finally, is diversifying risk. So, like I said before, you can look for additional confluences for your set system and how you can improve it. So maybe you want to increase your R2R. How can you look to do that? Knowing your school of thought, how can you do it? Okay, and then you've got your risk management improvements. Should you move your stop loss, for example, should you move your stop loss to break even once it hits a specific R2R or a specific area, etc. You've got system improvements. So this is when you track your data and you back test your data, and you can look for specific systems, right? I mean, not systems, sorry. Things that keep showing up in your data, and you can add on additional risk maybe. And finally, market diversification. Maybe the market that you're working on or currently looking at right now is doing a certain pattern. So maybe it's consolidating. So you need to look at other markets. Or you can look for trading specifically like a system that specifically in consolidation, and a system specifically for trending markets.